On this unit, we're going to analyze and post the transaction related to the purchase of raw material on 2016. But before that, let's remember briefly the previous unit. It focused on the analysis and accounting for the subscription of the initial capital. A collection takes place on 2016 due to the owner's contributions. This transaction does not impact on the income statement, since there are no incomes or expenses related to it. This is because owners' contributions do not increase or reduce the value of the company. When subscribing the capital of a company, the shareholders are just moving their money from one pocket to another. It does not increase their wealth. It's important not to forget that within the context, company means the entire company shareholders unit. Finally, this transaction should be reported on the balance sheet as paid-in capital. Let's remember that the balance sheet does not show at this point in time any cash variation. This is because we will generally reflect the impact on cash of all the transactions once we've calculated the net cash flow of the period. This transaction that we are going to analyze now describes the purchase of products that Copen will then sell without any transformation. First of all, like we did when recording the previous transaction, we identify the potential collections and/or payments that could have taken place in 2016 due to this transaction. Ultimately, it means to find out if the transaction involves some cash inflows or cash outflows in 2016. Indeed, the payment for the products purchased between January and November takes place in 2016. But why were not December purchases paid in 2016? Because the wording of the case states that the payments take place 30 days after each purchase date. January purchases are therefore paid up in February. February purchases are paid up in March, and November purchases are paid up in December. All these payments take place in 2016. However, December purchases are going to be paid up on January 2017, outside 2016, which is the period under analysis. Let's reflect this payment on the cash flow table. Since Copen buys every month the same quantity of product, 2,000 units, in 2016 they pay for 38,000 units, that's to say, 40,000 units purchased in the whole year 2016 minus 2,000 units purchased in December. The payment of December purchases is still pending at the end of 2016. The products are valued at its purchase price, 15 euros per unit. We identify now the potential incomes and/or expenses related to the purchase of products in 2016. We proceed as in the previous transaction. If the company's value increases, or in other words, if Copen's wealth increases due to the purchase of products, we will be able to state that this transaction generates incomes. On the other hand, if the company's value decreases, or in other words, if Copen's wealth decreases due to the purchase of products, we will be able to state that this transaction involves an expense. As has been said several times, it's important not to forget that within this context, company means the entire company shareholders unit. Well, we can say that this transaction does not involve incomes or expenses. By purchasing 40,000 units of product, Copen does not become richer or poorer. Copen has only acquired some goods that are worth the same that the money they paid for them, or the money they incurred the obligation to pay. Nothing should be therefore reported on the income statement. Finally, we analyze how the purchase of products affects to other assets, liabilities, or capital. Ultimately, we need to find out if the purchase of products may lead to variations in the belongings, the rights, the liabilities, or the capital of the company. So, yes, an asset other than cash changes. Inventories rose, because due to this transaction the company becomes the owner of 40,000 units of product. These units are valued at their purchase price, 15 euros per unit. But besides that, a liability arises from this transaction, a debt with the company's suppliers. As described above, the 2,000 units purchased in December at 15 euros per unit are going to be paid in 2017, and therefore at December 31st, 2016, the date when this analysis is carried out, Copen still owes those units to its suppliers. It's obvious that this transaction does not involve any modification in capital, since the shareholders neither contribute nor reduce it. All the belongings of any company, raw material, machinery, buildings, rights to be paid, cash, etc., have to be reported on the assets side of the balance sheet. We thereby post the purchase of 40,000 units of product. On the other hand, companies' debts with its suppliers are payment obligations that should be posted on the liabilities section of the balance sheet. As can be seen, in both cases, initial cash balance is zero. It's obvious, since the company was established in 2016 and all the balances within the opening balance sheet of the year when a company is established are zero. However, despite this, it's advisable that the format of the balance sheet always counts on the columns to reflect the opening balance sheet, and not only the closing balance sheet. This is because the opening balance sheet is not going to present zero balance in the years thereafter, and to calculate the final balance of any line item of the balance sheet is necessary to add to the initial balance of each item the potential variations related to the transactions that take place during the period under analysis. Hence, in our case, the final balance of accounts payable, raw material supplier, is only equals to the impact on the transaction under analysis. We do not try to come up with the final balance of inventories yet, because the sales of the company also impacts on the volume of inventories. Let's summarize this unit. We have posted the purchase of products, raw materials. Regarding cash flow, that's to say collections and payments, Copen paid up the purchases corresponding to the period January-November. This is because, in accordance to the payment conditions agreed with the supplier, December purchases are paid in 2017, 30 days after the purchase date, and therefore outside 2016, which is the period under analysis. But this transaction has no effect on the income statement, since there are no incomes or expenses related to it. This is because the purchase of products does not change the value of the company, or in other words, the company does not become richer or poorer due to this transaction. The purchase of raw materials means only exchanging money for something of equal value. Finally, the balance sheet shows the two effects of this transaction, in addition to the effect on the cash balance that is not shown here yet. On the one hand, inventories of raw material, an asset, increases. On the other hand, accounts payable to raw material suppliers, a liability, also increases. In the next video, we analyze and account for the next transaction, which refers to labor expenses and general expenses.